Once, what Wall Street calls shareholder value was seen as manipulation. If a company spent its own money to lift its stock price, it wasn't clever, it was fraud. Executives could go to jail, companies could be fined, reputations ruined. Today, it's the opposite. Stock buybacks, when a company buys its own shares to push the price up, are now the most powerful tool in corporate America. They lift markets, boost CEO bonuses, and quietly send trillions to shareholders, all without creating a single new product or job. So, how did something once illegal become the backbone of modern capitalism? Welcome to the Financial Historian, where money, power, and history collide, and nothing is ever simple. The story begins with a crash. In the 1920s, markets were like casinos. Executives played with their own stock. Bankers made secret deals. Fortunes rose and fell overnight. The New York Stock Exchange was a theater of illusion. When the crash came in 1929, those tricks turned deadly. Companies had used their own cash to prop up stock prices, giving investors false confidence. When panic hit, they had to sell, making the crash worse. By 1933, confidence in capitalism was broken. Factories closed. Banks failed. Unemployment hit 25%. People no longer trusted Wall Street or the idea of a free market. President Franklin Roosevelt did something radical. He rewrote the rules. The Securities Exchange Act of 1934 created the SEC and banned companies from manipulating their own stock prices. The market was meant to show real value, not vanity. For the next 50 years, stock buybacks were basically illegal, not by name, but by definition. Buying your own shares to push prices? That was market manipulation. For half a century, the economy grew without this trick. Companies invested in research, factories, and workers. CEOs built, not traded. The stock market reflected industrial strength, not accounting tricks. The system wasn't perfect, but it worked. Then in 1970, a quiet revolution began in universities, not factories. Economists like Milton Friedman said a company's only job was to increase shareholder value. For corporate leaders, this was freedom. No more being judged on stability or employment. Now, the stock price was all that mattered. By the 1980s, politics and economics aligned perfectly. Ronald Reagan came to power with promises of deregulation, faith in markets, and smaller government. Wall Street thrived. Investors demanded higher returns. CEOs wanted flexibility. Corporate America wanted a way to lift stock prices fast, without building new things. In 1982, the SEC quietly passed Rule 10b-18, a one-page rule that would reshape capitalism for decades. It created a safe harbor. Companies could buy back shares without being called manipulators, as long as they followed loose limits. No debate, no hearings, just a quiet rule change. Suddenly, what had been illegal became legal, as long as it was called returning value to shareholders. The impact was immediate. Before 1982, companies rarely bought back stock. They paid dividends, invested in growth. After 1982, buybacks exploded. At first, it was small, a few billion a year. Then it became an addiction. By the 1990s, buybacks passed $100 billion annually. By the 2000s, they were normal. By the 2010s, buybacks reached over $1 trillion a year. The math was simple. Fewer shares in circulation meant higher earnings per share. Even if total profit stayed the same, the company looked more profitable. Stock prices went up. CEO bonuses soared. No new products. No new jobs. Just numbers. Buybacks became corporate plastic surgery, looking richer without actually being richer. Wall Street loved it. Tech companies in the 1990s used buybacks to offset stock option dilution, effectively paying executives with shareholder money. Then came 2008. After the financial crisis, banks were bailed out, and the buybacks continued, often with borrowed money. Between 2009 and 2019, the top 500 U.S. companies spent over $6 trillion on buybacks, more than all new capital investment combined. Buybacks don't build strength. They build illusions. They make companies and markets look healthy until they aren't. By the time buybacks became routine, growth meant fewer shares and higher charts, not new products or ideas. The economy turned inward. Companies fed on themselves. Investors chased reflections of wealth, not real value. Governments adapted too. Rising stock prices became proof of stability. Leaders pointed to the market and said everything was fine. Central banks treated stock prices like vital signs. But illusions last only as long as people believe in them. Buybacks were defended as efficient capital allocation. Extra cash? Return it to shareholders, they said. On paper, it made sense. In practice, it hollowed out the system. R&D slowed. Wages stagnated. Productivity flatlined. Executives grew richer, not because they led better, but because rules let them boost. Bonuses tied to stock prices. Buybacks became the easiest way to raise stock prices. By 2018, U.S. corporations spent more on buybacks than capital investment. Apple, Microsoft, ExxonMobil alone were over 20% of repurchases. Industries became stock management machines. Airlines, retailers, tech giants, once symbols of innovation, were now financial entities. Their product? Shareholder returns. The 2008 crisis should have ended it. Instead, bailouts restored the illusion. Cheap money flooded the markets. Debt became cheap. Companies borrowed to buy stock, the largest wealth transfer in history. Between 2010 and 2020, U.S. corporations spent over $7 trillion. That's Japan's GDP. The top 1%, who own over half of equities, captured almost all of it. Workers got unemployment. Executives got record bonuses. By the pandemic, companies were more leveraged than ever. Revenue vanished, yet public bailouts arrived. The money that could have built resilience was gone, converted into stock highs and bonuses. The illusion was complete. Buybacks became an ideology. Efficiency over endurance. Extraction over creation. Clip. Every repurchase enriched shareholders. The wealthiest 10% who hold 90% of stock. Wealth. Everyone else saw wages lagging and costs rising. The laddered prosperity remained, but rungs were missing. Buybacks weren't prosperity. They were its illusion. Without them, stocks fell. Companies borrowed more to continue. Debt doubled. Balance sheets swelled. Profits looked endless, an illusion. Manipulation became policy. Governments relied on high stock prices to keep confidence. High prices calm the public, fuel pensions, and make leaders look competent. Illusions grew. Quietly, beautifully, dangerously. The 1920s were fueled by cheap money, inflated stocks, and faith in endless growth. Today is no different. Collapse is only a matter of timing. Buybacks were meant to show strength. Instead, they showed dependence. Companies bought the past, not the future. The irony? The same mechanism that destroyed markets now sustains them. What was once manipulation is now called efficiency. What was illegal is now the engine of growth. History shows where this leads. Bubbles and addiction to reflections of wealth. Relying on rising stock prices for stability makes the system fragile. It's not real growth. It's delayed gravity. The next crash won't be of innovation. It will be a crash of trust in investors, in governments, in the system itself. In 1934, manipulation was banned to protect markets. In 1982, it was legalized to make markets look good. This isn't progress. It's regression disguised as sophistication. The most expensive illusion isn't a bubble, it's belief. Belief that confidence can last forever and numbers replace real value. When belief breaks, every illusion collapses. Stock buybacks were made legal to appear efficient, but efficiency without purpose is just decay. The system that criminalized manipulation now depends on it. It's not capitalism. It's choreography, making decline look like success. If this changed the way you see markets, hit subscribe. History has the answers. I'll show you where to look.